Hey guys, this is Evan, and this is Sense or Sense. And today I want to try to save you a lot of sense and give you some common sense on how the rich continue to get more and more rich. It actually is kind of like a formula. I found throughout the last 20 plus years that I've been a financial advisor and a hedge fund trader that there are certain things that most wealthy individuals practice, and it's been across the board for a majority, if not a great majority of them that I've met and interacted with and had as clients. And so I wanted to share to you today some things that I've found to be the most interesting and actually pretty easy to implement as an individual over time. Now, none of this is going to happen overnight. This is not a get-rich-quick scheme. This is not advice on how to get rich doing something crazy. This is about true tested things that I've seen that very wealthy individuals have proven time and time again over many, many years. So there are a few things that I want to get into today. This article here with the Wall Street Journal is a part of what I want to talk about. It talks about the investment industry loves active ETFs. You probably shouldn't. And basically the summary of it is simply that there are more and more active ETFs coming online, and they're charging more, and the fund managers out there are trying to get you to pay more for their management. And over time, this is repeated over and over again with mutual funds and other forms of closed-end funds and now ETFs. It just doesn't pan out in the long term. You don't make as much money investing in active ETFs, active mutual funds, active closed-end funds, things like that over time as you do with being passive, indexing, and picking your own individual stocks as a portion of your overall portfolio. And you can read in this article, first of all, you can see here it says, you can see the dark blue here, the number of launches of new active ETFs over the years. You can see it was almost nothing in 2014 and 15, and it's grown to be well over half of all ETFs being launched now. And even the big dogs like Vanguard and BlackRock and State Street are all getting into it because they see profit margins. They see a way of making more money. And it says right here, selling products that track gauges such as the S&P 500 or World Index is a low-margin commoditized business that is killing many mid-sized asset managers. So there you go. That's why they're going for it. You can go down here and you can see that they are taking investors full circle, that is paying more to get less performance, ignoring the long-standing wisdom that active managers often struggle to beat the wider market after accounting for fees. This is rinse and repeat. This has been the same situation since at least the 1960s and 70s when the first index funds were starting to come out. Indexes typically outperform overall active managers. It says here, so far this year, active launches outnumber passive ones by more than 3-1, according to Morningstar. The ratio is roughly the other way around back in 2014. A 2019 rule change by regulators has played a big role in making these products ubiquitous. The performance record isn't great. Over the past 15 years, these vehicles have delivered an average annual return of 12.4% in U.S. blue chip stocks compared with 13.5% for their passive brethren, or 12.6% for active open-end mutual funds. Fees, which average 0.31% for active ETFs and 0.07% for their passive counterparts, add to the performance drag. So there you go. Now, that doesn't mean that all ETFs should be passive in your portfolio. There are small amounts, like very niche markets, overseas bonds, things like that, that some active management can be beneficial. But I wanted to showcase a little bit about what I've seen in wealthy people's portfolios, and they're mostly passive in their portfolios, especially their long-term retirement portfolios are almost all passive from what I've gathered over the last 20 years. So this is another reason why they maintain more wealth, is because they're not going after the active management. They're saving more money there. And you'll kind of hear this throughout the next several minutes when I discuss other things about wealth creation in the U.S. And that is what I've found over the years is that you basically are able to, if you're able to reduce costs and take advantage of certain tax situations and reduce your expenses on things, that you're going to gain a lot more wealth and you're going to become a lot more successful in at least the U.S. I can't speak for taxing authorities elsewhere, but in the US, it's very much skewed towards people who have money to be able to avoid legally taxing and legally paying high expenses. It seems like a lot of the bigger expenses, a lot of things always suppress the lesser individuals. Well, the wealthy have figured it out. And here's another reason why I've seen over the last 20 years that they figured it out. They own small businesses and write off everything. And I've been a small business owner since at least 2003, and I've had a small business prior to that, but I've owned many small businesses. And what I've found out over the years is it's very simple. If you own your own small business and you make money, you're able to write off a lot of things. You're able to take advantage of tax breaks that are specifically created for small businesses. You can write off a lot of startup expenses. You can write off retirement expenses. You can write off hiring new employees. You can write off all of your inventory. You can depreciate assets that you have. You can depreciate cars that you use specifically for your business. You can depreciate assets that you have that you use for your business, such as computers and desks and other materials that you use for your business. And it just allows you to make a lot of money, but be able to take advantage of the tax situation in the United States that is very, very heavily favors small businesses and very wealthy individuals. So having a small business allows you to somewhat control your assets that are coming in a lot more so than working for someone else. Another way is that you earn as much passive income through real estate, stocks, and other ways that are passive because it is taxed much less than earned income. And so let me give you an example of this. You can buy stocks, you can buy other assets in the stock market, such as ETFs, like we were just talking about just a few minutes ago. And overall, it is far more efficient for you to make a lot of money on those assets than it is to earn income. Every dollar that you earn through an employer, you're going to pay Social Security on, which averages about 15.3%. The employer pays for half of that, you pay for half of it. You're going to pay income taxes, and you're going to have to pay for other expenses as well. When you invest in the stock market or in passive real estate, you can essentially depreciate real estate. You can sell real estate in the long term and take long-term capital gains, which are at a much lower rate than income taxes. And you can also buy and hold stocks for a very long time and sell them, many, many years later for a large profit and only pay long-term capital gains on it. The maximum long-term capital gains you're going to pay is around 24%. It can be lower. It can be as little as almost 0% if you have lower income. But you can see how the wealthy that are in the higher tax brackets, they're in the 25, 30, 33, 35% tax brackets. If they're buying real estate and they're buying stocks and they're holding them long term and they're only paying 15 to 25% in when they sell those assets instead of earning income through basically working for someone, then they're going to pay a lot less in tax. And also, it's been historically shown that people who have a majority of their assets that they have in stocks and real estate, that they tend to be a much wealthier future generation. So that's one of the number one things that is an indicator of people earning wealth and becoming more wealthy is they have passive income streams, multiple passive income streams that are not taxed as much as earned income, and they kind of combine that with the income that they make day to day from employers or a small business. And that's how I've been able to do it over the years, is that I've owned multiple small businesses. I've been able to write off a lot of different things. I've been able to invest in a lot of stocks, real estate. You can combine all these things together and you can keep your tax situation in a much more controlled environment than you can if you're working for someone else and just having earned income. Because earned income is just going to ultimately, for the most part, is going to cost you a lot in taxes, whereas passive income is going to cost you a lot less. So the wealthy have figured out a way to create wealth by basically paying less. And that's as simple as it gets. That's the corollary of this entire video is if you're wealthy and you can have passive investments, you can make a lot of money. You can pay less tax on it by holding them longer. When you pay less tax and you're able to write off a lot of different things, you're obviously going to be able to hold on to a lot more money, and that just builds your wealth. Whereas individuals who work for someone else don't necessarily have access to that ability, and they're paying payroll taxes and Social Security taxes, and that adds up really quickly. Finally, I'm going to leave you with this, and this is one of my big secrets, is my clients, my wealthy clients, as well as myself, all have one thing in common for the most part. We live way below our means. We spend a lot less than our income that we take in from our stocks and our passive real estate and our income from our businesses and our job earnings. We spend a lot less most of the time than we bring in. Now, there are going to be times where you obviously spend more. That's a nice thing. You can spend more. But ultimately, living significantly below your means is another way that the wealthy continue to get wealthy in this country. And, you hear the old millionaire next door type adage of, the guy that drives the old busted up Camry or whatever tends to be the one that has the most amount of money. And that's true. You don't need to have things that are flashy, and you can live below your means and combine them with all these other things that we've discussed today, and you'll be in a very good position to grow wealth in the future. I appreciate you guys all tuning in. If you like this, please give it a like and subscribe to the channel. I love to bring more of this to you guys and bring my knowledge and my 20 plus years of investments to you all. I appreciate it. This is Sense or Sense. My name is Evan. See you next time.